Hello and welcome to today's webinar, Why Corporate Credit Cards Matter for Startups, presented by Early Growth Financial Services and Brex. My name is Patty Montoya and I'll be your moderator today from the Early Growth Financial Service team. I have a quick few notes before we get started. The webinar will last about an hour, and that includes time at the end for questions. So feel free to type your questions into the control panel, and we will answer them during the presentation or at the end. The next thing to note is that this webinar will be recorded and sent to all the registrants with the slide deck within 48 hours. You can also find this recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speakers today, I'd like to tell you a bit about Early Growth Financial Services. This is a quote from our founder, David Ehrenberg, and a few of the clients we've worked with. And here's a quick description of what we do. We're an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuation. Now, without further ado, I'd like to introduce our speakers today. Michael Tannenbaum is the Chief Financial Officer at Brex, the first corporate credit card for startups. Prior to joining Brex as its first employee, Michael was Chief Revenue Officer at Sophie, a leading U.S. student lending startup turned established company. In his previous role, Michael was VP of Finances and was in charge of making financial management decisions for the company, including around corporate credit cards. Thomas Piani is the head of business development at Brex. Previously, Thomas was a management consultant at McKinsey and Company in San Francisco, helping companies large and small in the financial services space make the best strategy decision. Michael and Thomas, it's all yours.
Hello, thank you, and thanks for that introduction. I just wanted to give you a little overview in terms of what we're talking about today, which is why corporate cards matter for startups. And then obviously in doing so, we'll talk a little bit about what we do that's different. But I think what's important to start with is just that 82% of startups fail due to cash flow problems, So it's really important that when you have a limited amount of capital up front that you've received and you've given up ownership for a startup, that you be really thoughtful and careful about how you spend your money. And one of the things, this is just a chart that Brex has done, is we spend a lot of time looking at our customers and looking at how much they've burned and how much they raised, just to try to be helpful and provide some benchmarks in the market. So we just included a link to that information if you're interested. And then the things that we like to focus on in terms of startups that are, some are characteristic of all small businesses, but others are really relevant specifically for this niche. But I think for us, we see visibility into cash balances, burn rate, and runway is super important. There is a lot of information, and I think what's unique about a startup is that you're dealing with often a founder or a founding team that's not necessarily financially savvy. So just having transparency is, everybody likes that term, but it's particularly acute in this market. And the ability to understand kind of who's spending on what is important. And it's something that Brex tried to use as we built our product. And this helps set the right company culture from the start. And it also builds trust with investors, because in the space, you have kind of people who have trusted you with money, and you're figuring out your company and your spending. And so this idea that you're actively managing your finances is super important to all those stakeholders. But ultimately, I think, and it's something that for folks on the phone and something for anybody that's kind of offering financial services to small business or startups or whoever, these businesses, their number one priority is growing your business. So when you're thinking about talking to this customer base, building products for them, solving their problems, yes, getting their finances under control is important, but it's in service of that broader goal. And it's something that I have to tell even, the finance team that I manage at Brex or that I managed at SoFi, which is, at the end of the day, this company is about growth and surviving, and we're there as a team to make that work, just like our product is there to help grow and maximize, business traction and profitability ultimately and scale. So I think that one of the things, so in terms of Brex, thank you for the introduction. We're a corporate card focused on startups, and tech companies.
Michael?
Yes.
Sorry, I feel people are not hearing you for some reason. Yeah. Can you guys hear us now?
We can hear you, but I don't.
Yeah.
Can you hear us?
I can hear you, but they're texting that they cannot hear you.
Okay. Should I speak closer to the microphone?
Okay. So I think they can hear you now.
Should we just start over?
You should just start from here.
Okay, sure. So I think that sorry if I'm repeating myself, but just I think what's really important in the world that we live in startups, but also in businesses broadly, is that people are focused on, one, getting visibility on their cash balances and their burn rate and runway. You've raised a certain amount of money up front, and you're really trying to maximize the runway for your business. And so it's really important for you to understand, particularly because most startups are run by someone who doesn't have a lot of financial acumen. It's not their number one priority. So they need a quick and easy way to understand, how much are they burning? Where is the money gone and going? I think transparency among co-founders and employees is always a good thing, but particularly acute in this market, because you have people who want to understand what people are spending on, and that helps everybody prioritize and make sure that what's being spent is also relevant to the business goals. It's also important just to actively manage your finance to build trust with investors. People want to know that the money they gave you is being spent appropriately, and also that you're going to have an accurate ability to predict when you need to raise money again, so you don't put undue stress on the business. And then the last point that I think is relevant for it's relevant for being a financial services, either service provider or product provider in the market. But it's also relevant, at least for me, being on the finance team at a startup, which is that everything that you're doing within finance in a startup is to serve the growth of the business. Ultimately, the business is going to survive or not based on the success of its product. And so you just want to make sure that poor cash planning, poor financial infrastructure, things of that nature aren't holding your company back, so it can focus on what's really important. Because in those early years of a company, as you're trying to gain traction in the market, that's really what's going to determine your product's going to work and you're going to find traction and success. And that's really what's going to make the difference. So I wanted to talk here about a couple of the important decisions that you're going to make as a startup in the financial sector, or with regards to financial services once you incorporate. I think that Brex, we're a corporate card, so that's among the decisions that you need to make early. But even prior to that, you've incorporated, and then you need a bank account in order to receive funding. So that tends to be the first thing that you need to do. Credit card is important because ultimately in this ecosystem, in technology, a lot of the vendors that you're purchasing from only accept credit card. So if you think about buying ads online, software, servers, computing, all of that, you're not going to pay net 30. Those merchants are expecting you to have a credit card. So pretty quickly, it's important that you have one to get business done. And then, as you all on the phone know, figuring out who's going to handle your accounting. Most of these companies that are being started don't have a professional or someone who's really qualified to do the books. And that's where quickly they need to find some form of an outsourced accounting firm or in-house staff to handle manage financial infrastructure for them. And we find that that decision also has to be made pretty quickly. So going back to the earlier slides, people have a sense for business performance, cash management, and also that helps establish the infrastructure that they need to raise additional rounds of funding. Because investors are going to expect a certain amount of financial infrastructure from which they can base their decisions. So I think one important thing to think about in this space of corporate cards and finance within startups is this concept of funding need versus payment need. So as I was mentioning previously, you wouldn't typically expect credit card to be that relevant in some cases, because you may think, okay, well, they can just use a personal card, or, most of these companies have a lot of equity, so what do they need to borrow from a credit card company? But the reality is that in the world that startups are operating in and tech companies are operating in, most of their vendors require a credit card. And a credit card so it's really a payments method, even though it's called credit card. So it's not really a funding need. I think funding needs for startups, typically you're starting with equity, because until you have a business, that's the cost. Equity tends to be a higher return form of financing. So yes, well, it's more expensive, but when you're really at inception, that's really the only type of capital that you can raise. And then over time, as you have more of a business, or frankly, more equity to support potentially debt or a line of credit, early stage companies will think about that. But I think it's helpful to remember that for for your average founding team who's not necessarily financially savvy, they need to distinguish between how do they pay for things, goods and services, and then how do they fund themselves. There's obviously a link there. And so a lot of what Brex does is educate people on this need for a credit card. So we talked a little bit about this, but to go into more specifics, I think debit cards, while they are linked to the payment rails, the issue with debit cards tends to be that it tends to come up as soon as you hire your first non-founder, because at that point, when that person needs to pay for something, I think most people are no longer comfortable giving that person a debit card, who then can go and quickly withdraw cash from their bank account. And if that debit card is lost, yes, while it may be protected with a PIN, it's not something that you really want standing out there. Credit cards tend to kind of help mask, sort of put another party in between you and the merchant and in between you and the employee, and sort of protect the bank account through a 30-day window, which is helpful. I think it's also beneficial in general to pay bills with a credit card rather than debit or ACH. Credit cards, including Brex, often offer 30-day plus payment terms and typically offer rewards. So it's sort of a shift from the merchant to first the credit card company, but then to the cardholder, and that is in the form of rewards. And that typically also is an important and valuable form of either cost savings or potentially, I guess you could say, perks earned. And I think that's something that is available in the marketplace, and it's important to capitalize on that. I think one thing I haven't spent a lot of time on is this concept of personal guarantee and just personal cards. So it's really important to think about separating business and personal expenses. So while a personal credit card will give you the aforementioned benefits versus debit in terms of safety, payment terms, rewards, you don't want to mix personal liability and company liability. If you did, then all these companies would be sole proprietorships. But the reality is people set up a corporation with the specific purpose of limiting personal liability. So it's never a good idea for a founder to have a personally guaranteed credit card. And it's also, in general, as we've been, the theme of this discussion is kind of keeping your finances in order. You don't want to have a lot of personal charges kind of mixed in with your credit card, because then it starts to become unclear, which is the founder's personal life and which is their business. And so it's generally a good idea to keep those systems separately. And in doing so, it helps give you visibility into employee expenses across the company, because if everybody's using a corporate card, you're not waiting for people months later to tell you, oh, sorry, back in December, I charged this thing and now I'm owed it by the company. And so from an accounting perspective and being efficient about close, it's actually easier to not be chasing people's personal reimbursements and be finding out about expenses later. And so with that, I'll turn it over to Thomas to talk a little bit more about how Brex works and how it can be beneficial.
Thanks, Michael. So I think what Michael just walked us through is why does it matter? Why do startups should startups care about managing their finances, and then how can corporate cards be a useful tool in doing so to help with their payments, to get benefit of float and rewards, and to separate personal expenses from company expenses. It makes a lot of sense for a startup to consider getting a corporate credit card. The problem is often we find that startups face a number of challenges in actually getting corporate cards, even if they're convinced that it's a good idea. So the typical, the first challenge that startups face is, very often if you're a startup, by definition, you start off with a new business idea. You don't have profits yet. You haven't been around for a while. You don't have in some cases revenues yet for a while. And so you don't look like a typical business. And for a traditional card provider, that are mostly banks usually, it's hard to evaluate you and understand what is the risk of giving you a credit line or a corporate card. So it's hard. Traditional providers have a hard time of figuring out how to evaluate you. And usually the way they solve that problem is by asking for a personal guarantee, meaning that they give you a corporate card that is a card for your business, but you as the founder or the CEO of the company that is applying for the card is personally liable for the card. And we'll talk more about what that means in a minute. Obviously that's a problem because startups are more risky businesses, right? So startups, they have a high upside if they work, but often not all of them work. So you don't want to personally guarantee your card. Moreover, what we find often with some of our customers that come to Brex is, if you're a founder and you're either young or international, which is the case for a lot of startup founders in the US, well, it's even more of a problem because you don't have personal credit history in the US, or not a lot. And that, in some cases, will prevent you altogether from getting a corporate card. And then, in addition to that, one of the challenges that startups sometimes face when they get a corporate card product, if they can get through the issues of getting the personal guarantee and they have enough credit limits, etc., is that cards are, one of those financial products that has been around for a while and hasn't really evolved much. And so it's, there's not a lot of flexibility in adding new users and setting their limits, integrating with your accounting software, using your card to do a little bit more than your payments, but also helping you manage your business. So to dive into the concept of personal guarantee a little bit more. So this is a topic that we care very deeply about at Brex, and we spend a lot of our time educating founders on what personal guarantee or personal liability really means, and why should startups and founders care about that. So personal guarantee means that you are, as the person that is signing up and is the owner of the corporate card account, you are personally liable in addition to the company for any charges that remain on the card. This matters, as we said, because startups have a high failure rate, right? So you start a company, you establish a corporation, you have an idea, you want to go through with it. You want this to work, of course, but if the company ends up like not working out, you don't want, as the founder, to be personally liable for charges that were incurred by the business. What is interesting to know is that 60% of founders today are exposed to personal guarantee because they're using traditional corporate cards that actually have personal guarantees in the terms and condition. It's often something that's not like obviously like marketed by traditional card providers. So what you see on this slide is an example of the Amex American Express terms and condition, and you see deep down in those terms and conditions, there's a couple of lines that say, we are agreeing to be jointly and severally liable with the company for all charges to the account. So that's what that means. It means that if the company goes out of business and there's a balance that remains on the card, then you, as the founder, are personally liable for paying that balance. And if that balance goes unpaid, it will be reported to your personal credit file. It will go on your impact your personal credit score, and have impact that can have in terms of you getting your next mortgage or whatever, or getting personal credit cards, etc. 60% of founders are exposed, but the majority of them, like 80% of founders, based on our research, are unaware that they're actually exposed because, as I said, it's not like very obvious often, and the exposure can be pretty important. Just to dive a little bit deeper on that, right? This is personal guarantee is something that's just so common among the industry for traditional providers. So American Express, all American Express small business cards, the one from the American Express Business Open cards that are the ones that as a startup you're eligible for, they all require personal guarantee. Same with Capital One, same with Chase. Same with all of the other typical providers that you could think about. And often, these are hidden in the user agreement, in the disclosure, etc. As obviously, that can have a big impact. Personal guarantee can have a big impact because if the payments or delays in payments for your corporate card account get reported to your personal credit account, that will have a points impact that lead to an issue the next time you want to get a mortgage or you want to open a personal credit card or get a no loan, etc. And we at Brex, one of the things that's very different about Brex is that we do not require personal guarantee. So we're the only provider out there that doesn't require personal guarantee. And the reason we don't is because we realized that was such a big issue, and we don't think that as the founder you should be personally guaranteeing your card, because by definition you're starting a business, you're opening up a corporate card for your business. You don't want to be personally liable for it. So that's something we care a lot about, and that is one of the reasons why Brex is very different from traditional alternatives. So the other thing that, beyond kind of personal guarantee, when you think about how to choose your corporate card, and what is the corporate card that makes the most sense for your business, as we just discussed, personal guarantee and whether that card requires personal guarantee should be an important consideration given the dangers that we just talked through. The other important thing that often founders will ask about, and we will try to understand better, is what are the types of rewards that the card is offering. Because obviously, kind of as Michael walked us through earlier, one of the big advantages of using a credit card to pay for your bills is that you get rewards out of it, right? You get money, you value back for your business. What's sometimes hard to think through though is all card providers have different ways of structuring their rewards. There's different types of points that you can use for different things. You earn on them on different types of categories, and sometimes it's hard to think through in a logical way about what is the best program for my business, right? Based on what I'm spending, what my business is spending on, what is the program that's going to give me the most value. So that's something that at Brex, when we first launched our card, we didn't offer rewards, in the first version of our card, and then we actually spent more than a year looking at what startups were spending on and trying to understand what would be the best way to give them value back. And that's how we built our rewards program, is really thinking through what would be the program that would provide the best value for the average startup. So when you think about evaluating a card rewards program, there's kind of three areas that you should be looking at. The first one is, how are you earning rewards? How are you earning points? So typically card rewards are structured either as a way, like when you're earning points on your spend. Sometimes it's directly cash back. Sometimes it's points that you can then turn into cash back. In most cases, it can be constructed as points. So one of the first question is, how many points are you earning per $1 spent, and on what categories? Because cards, often have what they call multipliers, which are categories where they will give you more than 1 point per dollar, with like 1 point per dollar being kind of the baseline that you get on everything else. So what's important is to think about, are those categories things that my business as a startup is actually going to be spending on? Sometimes there's like traditional small business card will give you multipliers on things like shipping costs. That can be very helpful for some businesses, but if you're like a software company, you don't have any shipping costs, right? So you're not really going to be spending on shipping, so that's going to be useless for you. The other thing to think about with multipliers that's often like hidden when you first look at the offer for a card is, what are the caps on those multipliers? So very often what credit card companies will do is they will tell you, you know what, you're getting like 3 points per dollar on everything you spend on restaurants, but actually that's only for your first $50,000 of spend in the year. And once you hit that $50,000, you will only get 1 point per dollar on everything else for restaurants. So that actually matters a lot, right? Because that offer with the 3 points per dollar may look like something that is like really attractive, and you're thinking, oh, my business is spending a ton on restaurants, so I should do that. I'm going to get more value out of it. But if you're actually going to be spending enough that you're going to hit that multiplier, 3 months into the year, and then you're only going to get 1 point per dollar on everything else for the next 9 months, then that might actually not be the best option for your business. So one of the things that we did at Brex is we did not put any caps on our multipliers because we want to be like very clear with what is the value that you're getting as your business. So we offer multipliers on ride shares, travel, restaurants, and all software subscriptions, and those are uncapped, meaning that however much you spend on this, you will get those multipliers. The last thing on the earnings side is sometimes you have sign-up bonuses or offers that you can get. So on these, what you want to look at is, what are the requirements to get them? Sometimes there's like spend requirements, or you have to be a member with the card for a certain amount of months before getting the bonus. So you want to be careful of what that means. And then you also want to understand what is the value of those offers, right? So for instance, the way we approach that at Brex is, instead of giving you, giving a point bonus that is often worth in the neighborhood of like $500 in terms of redemption value, we built a series of deals and offers that we offer with a number of providers of the startup ecosystem that our companies get access to as soon as they sign up for Brex. There's no requirement of spend to get access to those offers, and that can give them back, as much as $25,000 in value. So like really a lot more value if they're actually using those services. So that's on the earning point side. Then the next question is, okay, how can you actually use those points, right? You're going to earn a bunch of points around the rewards, but how do you use them? So first question is, what are the ways that you use them? Is it like cashback or statement credit? Do you get like travel purchases? Like, can you use those points to buy travel? Do you get like transfers to like other loyalty programs? And what do you care most about, right? If you care more about just getting straight value back for your business, you're probably going to favor a card that has like a cashback or statement credit option. If you want to use those points like personally, maybe you'll favor a card that has where you can use those points for travel, or you can use those points and transfer them to like hotel loyalty programs, for instance. And then related to how you can use points, like obviously what is the value of those points actually matters, right? you think the traditional value of points is, you think like 1 point is worth 1 cent, but actually that's not always true, right? There's some card providers where, depending on how you use those points, their value decreases. So for instance, often, like typically American Express, if you use your points for cashback, so to get like a statement credit, the points will be worth less than 1 cent per point. So they will be. So if you think you're going to want to be using your card to get your statement credit or cashback for your business, then those cards may not be the best option. And then you also want to see whether there's any like limitations on redeeming points. Like, do you need to earn a certain number of points before you're able to redeem them, or is there like a limit to the amount of points that you're gonna be able to redeem in a given period, or your points going to expire? For instance, at Brex, the points never expire, and there's no limit on the amount of points that you need to earn before you can redeem. And then the last thing when you think about rewards is, you want to compare rewards to how much you're actually paying for the card, right? Because it's great to have a card that has a lot of rewards, but if it comes with a very hefty annual fee, then it may not be worth it. So looking at the annual fee for the card and also the annual fee for adding new users also matters. So for Brex, we don't have annual fees for the first 5 cards. We typically charge like a $5 per user per month fee more above 5 cards. But because we partner with Early Growth Financial Services, we are waiving those fees completely for Early Growth Financial Services community of companies. Meaning that using Brex is completely free. But depending on what the options that you're looking at, that's something you want to be careful of. And kind of looking through all of those aspects, that's really how you get to make the decision and choose the card that will give you the most value back for your business and be the most beneficial for your company. So we kind of took through Brex like throughout the presentation, so I'm not going to spend too much time on this, but as I think we explained earlier, right? We offer a corporate card that we designed from the ground up, especially for startups and newly formed companies. Some of the things that make us different from traditional alternatives are, number one, the no personal guarantee. So we talked about why that matters. So we are the only card out there that doesn't require personal guarantee and doesn't also require any sort of like security deposit like as collateral. And we also can give higher limits. And the way we do that is we use information on how much money you have in your corporate bank account, and that's what we use to give you a credit limit. So we don't require personal credit scores or like look at personal credit history, or we don't collect SSNs, etc. We just look at your business and give you a card that doesn't have personal guarantee. We also have a rewards program that is tailored for startups. So as I mentioned earlier, right, we kind of looked at what our customers were spending on, what are the categories of spend that they were spending the most on, and that's how we like decided where to put multipliers to make sure that they were getting the most value out of Brex compared to other programs. And we also made sure to not put caps so that you could earn those points as much as you're spending. And then the last thing that we didn't talk about as much here is, what are some additional like features on the technology and expense management side that can help just make your life easier and help you focus on really running your business. So Brex, because we built the technology stack to create this corporate card from the ground up, we can offer like a number of technological features that traditional providers that have been around for many years cannot. So some of the things that we do differently, we make it very easy to add new users and set their limits. All of that can be done through our online dashboard in no more than a minute. We can issue virtual cards instantly. You get a physical card in the mail 3 days later. We capture receipts automatically at the time of purchase via text or email, and we match them into your dashboard so that you don't have to submit receipts at the end of the month, but you keep clean financials. if people want to understand like what you're spending your money on. And then we also have very clean integration with accounting software that startups typically use, whether it's QuickBooks or Xero or Expensify or NetSuite. We integrate with those very easily, which makes it easy to sync your Brex transaction and import them to your financial statements. We're, as Michael said, we're a startup ourselves, and that's why we really care about providing the best product for startups. We were founded 2 years ago. We were in part of the Y Combinator Accelerator, and since then we've been going quite quickly. We're in San Francisco. We raised our Series C last October, and we keep focusing on our goal to provide the best corporate card that we can for startups and like early stage companies. And the last thing I say is, because we care about startups and we work with early growth financial services, we are waiving all card fees for life for all early growth financial services companies. So using Brex for companies of the early growth financial services community is totally free. So I think that was it in terms of the content we were planning to cover. Would love to hear any questions if there's any question on anything that was covered by either Michael or myself so far.
Thomas, there's not a question right now, but I wanted to see if you could answer. What do you think is the benefit of having a corporate card in terms of fundraising, like speaking with venture capitalists? Do they care if you have like a personal card? Is this something that would ruin an investment?
I think it's less about venture capitalists caring than it is about having your books in order. Because I think when you meet a VC, they express interest, there's a certain expectation of data that you can show them about your company. And if that's not in clean order because you have a million personal reimbursements that haven't been processed, and you have a credit card that is kind of not so good, so it doesn't integrate with anything, and most of your expenses, or at least 30% of them, are on card, and you have nothing in order, I think that will definitely impact your ability to quickly respond with some sort of financial picture of your business. But I would say that for a founder, it's much more personal, right? In that sense that, and Thomas covered this a little bit, but most people really won't know, they're not aware that they've personally guaranteed their card. But if they've had anything go wrong, or they apply for a mortgage or another financial product, and there is this sort of impact of their existing business on their personal credit score, it's almost like once they are aware of it, then it's very much a problem. And so I think those are the two areas where you see it be relevant. One related to VC, and then one just related to being a founder.
Thank you. We have a couple of questions about Brex, if you can answer them really quickly. I know you already went through this, but what are the requirements to qualify? And then also a little bit about the rewards that Brex offer.
Sure. So I think to qualify, what we look for is a US EIN. So we're dealing with C corporations only. That's one. Two is we're looking for about 100,000 in a bank account. So I think in a corporate bank account. And so if you're in a Brex basis, it's credit limits off of cash balance and activity in the bank account. So we typically work best with startups or tech companies or professional services companies that have over 100,000 in the bank account. And then lastly is a US office address to ship the card. So we only ship the card domestically, although it does work internationally with no foreign transaction fees. So I think that answers your first question. And then on rewards, Thomas, who runs the rewards program, can certainly correct me if I say anything wrong, but I would classify it, or I would characterize it as helpful in two ways. One, we have a series of multipliers on the services that startups use the most. So these multipliers earn you points. So things like software, rideshare, travel, dining. And then you also earn 1x points on categories without a multiplier. Those points are redeemable both for statement credit and for travel. And then separate from points and multipliers, we have a suite of I would say deals and discounts on services that are used heavily by our demographic. So things like Amazon Web Services, Google Ads, WeWork, Salesforce, even food delivery like Caviar for the office or Instacart for office food. We have a bunch of discounts that are really valuable as well that add up to about $30,000 of value. Does that help?
Yes, definitely. I think that helps. That's all our questions for now. If you have any last comments, but if not, I will be sending this in a PDF format. I will send the recording of this. You can contact Thomas and Michael after this with any questions. Thank you guys so much for this. I thought it was really interesting. Anything that you want to share before we leave?
No, I don't think so. Thank you very much, Patty, and thank you to Early Growth for inviting us to be part of this today. I think we really enjoyed it. Hope that some of the information we shared was insightful. And as you said, for any folks on the phone that have questions or want to know more about Brex, there's two ways that you can reach us. So one is we have a dedicated email address, gfs@brex.com, that you can email that goes straight to Michael and I with any question or if you're interested in applying. The other is there is a link included in the PDF that Patty will be sending around that is like a direct sign-up link. Through both of these methods, we'll know that you come from the Early Growth community, and we'll make sure that you can get the waived card fee offers if you end up signing up for Brex. So thanks again, and please feel free to reach out with any questions.
Perfect. Thank you, guys. That's all. Bye.